Let's dive into the concept of stock valuation. And to make it easier for you to understand, let me start with a simple analogy. Think of buying stocks like buying property. When you're shopping for a home, there's a difference between the price and the value, right? The price is just the amount that you're paying for the property, while the value is what the property is truly worth based on its size, location, condition, and potential appreciation. Maybe it depends on the land size, right? With stocks, the price is what the market is charging for a share of the company. But the value is what the company is actually worth based on its fundamentals like earnings, cash flow, and growth potential. As investors, our job is to figure out the difference between the price and the value and make smart decisions. Warren Buffett puts it beautifully. He says, "It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price." So what does he mean by this? If you pay too much for a great business, it can still be a lousy investment because you've overpaid and it may take years to see a return. On the other hand, if you can find a great business and buy its shares for less than what it's worth, that's where the magic happens. That's where a great business becomes an excellent investment. Now let's talk about intrinsic value. Intrinsic value is simply the true worth of a company based on its fundamentals. So not the price the market is charging today. Think of it as the real value of the business if you strip away all the market noise, the hype, the fear. So our goal as investors is to figure out what the company is truly worth, and that is its intrinsic value. Then compare it with the price that it's trading at. So if the current price is lower than the intrinsic value, it's a good opportunity to buy. But if the current market price is higher than the intrinsic value, then obviously it's not a good time to buy. So just a quick look at this chart that we have over here. So imagine this black line is the intrinsic value, okay? So that is the true value of the company. And this line, this is where the market price is, okay? The stock price, right? So when the stock price is below the intrinsic value, this is where you want to buy because it is at a great discount. Just like when you go shopping and you look out for great bargains and discounts, same goes with the stock market. The value of the company does not change overnight, but the stock prices may, depending on the market noise or the fear or the greed or anything, news. If it was me, I would not usually buy at one go when the market is below the intrinsic value. So when the market drops here, for example, and if I determine that the price is a worthy price and it's below the intrinsic value, I may buy maybe 1% or 2% of my capital, right? Because there is always a margin of safety because prices do not stop at the intrinsic value. They may go a lot lower and they may fluctuate, right? So I'll give myself multiple entries. I allow myself multiple entries by entering my purchase in tranches. So I may buy 1% here, and if it goes down, I may buy another 1%, and if it goes down, I may buy another 1%. So maybe at the end of this period, I would have entered 3% maybe, and then after that, the price goes up. When the price goes above the intrinsic value, this is when the stock price is overvalued because it is overpriced. It is beyond the actual value of the company. Okay? So depending on the strategy that you employ, you may want to hold on to the stock price if you are an absolute long-term investor, or if you want to exit and then hope for a retracement, which may not happen, and then you may want to sell and then re-enter when the price is below the intrinsic value again. There's several methods to screen for undervalued stocks, okay? And we will go through these different methods, but One of the quickest way, or rather one of the first steps that I usually do to screen whether a stock is worthy as an investment is to look at the PEG ratio. Okay, so the PEG ratio, the PEG ratio, is actually the price earnings ratio divided by the expected earnings per share growth rate. Okay, so people usually look at the PE ratio, the price over earnings ratio, and they may say that the price is overvalued based on a high PE ratio. This is very important, okay? Take note of this. A high PE ratio may not necessarily mean that the stock is overpriced. Why? Because you need to consider the potential growth of the company. So if the company's growth rate is increasing over time and expected to increase in the near future, so even though the PE ratio is high, because of the potential growth of the company, it may still be considered cheap. So the PEG ratio, I've explained the formula. As a rule of thumb, we look for PEG ratios of 1.5 or less. Okay? So when you take the PE ratio divided by the expected growth rate, if it's less than 1.5, it indicates that the stock is fairly priced or undervalued relative to its growth. While the PEG ratio isn't the most comprehensive method, it is a great tool for a quick check. I recommend finviz.com. So when you go to finviz.com and then you go to Screener, then you go to Fundamentals, and right below there you see the PEG ratio, okay? So right now there are 10,341 stocks in the list. And okay, we can't do 1.5 here, so let's do under 2, okay? So let's look for that have a PEG ratio, PEG ratio of under 2. Okay, now from 10,000 we have 735. Okay, so this is the first step. The first step is to screen for potential undervalued stocks. Okay, and then after that we have several other steps that we will do, but this is the first step for you to screen your potential investment. Okay, and I'll see you in the next video.